foremost, I've tried to explain sales tax to my wife, and she just looks at me very funny. I've yet to figure out how to properly break it down into a format that, in layman terms, but we're going to do our best here at least.
Yeah.
So let me share my screen. We'll jump into this fun little presentation here. All right. So the unsexiness of sales tax in the United States. For many, this can be a very daunting subject. It can be burdensome. It can be very scary. The U.S. is very big on displays of force. So you'll hear a lot of things about audits and other things, and they love making examples here. Um, the truth is, don't be afraid of it. Don't let it get to you. There are experts in place here to assist you with this process, and we can help you, not only ourselves, but there are other sales tax experts and then there are accountants in this call today that are also very gifted at such a subject. And I would strongly recommend leaning on those accountants, as we've been hearing about COGS and best practices, especially when you're looking at the European markets and so on and so forth. So there's a lot of brain talent here that I'd recommend you listen to. Going into how is sales tax calculated in the United States versus VAT? Here we go. It's going to be a nightmare. I apologize. So in Europe, VAT is very straightforward and simple. It's a flat rate, depending on the country that you're working within. Apologies, guys. I'm oversimplifying from a U.S. perspective. I know it's more complex than that. So, and hopefully Nick will straighten me out on that area. But when we look at how the United States does it, we're very fragmented in nature. There's over 12,000 different jurisdictions, and each jurisdiction is unique. Every small town that you look at on any movie is a unique jurisdiction. So if you've ever seen any movie with small town, middle of nowhere, United States, they have their own unique tax rate. That's how complex we are. So there are various forms of how the tax is calculated. There's origin-based calculations, which is what it means is where the product or good are shipping from. States like Illinois, et cetera, kind of do that origin component, where it's coming from certain warehouses. And so sales tax needs to be charged based off of where it's coming from within those states that are origin based. Then we add to the complexity destination based states. These are states where you pay the sales tax or you calculate the sales tax based on where the product is going to. And then there's California, and they're just, part of my language, assholes. There's no other way of putting it. Their origin and destination. And so they really like to add to the complexity in the sense of not only are you having to calculate when a product ships from a location in California to another location in California, you have to both calculate where it's coming from as well as where it's going to. Finally, you look at tax exempt states. And so some of the things that you're going to see are like Oregon or Delaware. And in some of these environments, they don't bother with a sales tax. To them, they have other forms of revenue that they're able to make. Now, why is sales tax so relevant to the United States? This is how the US actually is able to record economics. So what is happening and why they're so laser focused on the sales tax is that is how they can figure out what the spending is going on within a state, within a certain region, so on and so forth. And all this data is reported up to the states and then aggregates and reports to the feds, which is then dispersed across the United States and broken down based off of certain trends and so on and so forth. So the reason why the complexity of the sales tax is because of the fact that there's an economic component here, and they're very laser focused in understanding that aspect. Now, all right, so we talked about calculations. That was a nightmare. Let's go talk about exemptions. So one of the other issues now is not only do you have to figure out what the right rate is, but if you're selling products that are such as supplements or other items, those things can be exempt depending on the state. Or in some locations, United States, when it comes to clothing, you'll see a case of where they will have tax holidays. So, for example, at the start of the school year, we're located here in Virginia, and the first weekend of the school year, they actually exempt most goods from sales tax. And the objective is they know they'll probably lose a little bit of sales tax revenue for that weekend, but the goal really is to make sure that the kids are able to get what they need in preparation for school. And so some states take these types of measurements into an account. All right, here we go. Economic versus physical nexus. We've heard this a million times. And, we probably are still scratching our heads as to what the heck it is. I'll be honest with you. The the feds and a lot of the entities didn't do a very good job defining things for layman's terms for the average person that wants to comply. So I'm going to try to simplify this as much as possible. In the early 90s, there was a ruling, Quill Wayfair, in the United States that went all the way to the Supreme Court level. The Supreme Court, when they ruled on this thing, they said it was unconstitutionally illegal at that time to compel a third party entity that had no operations within the state to have to collect or remit sales tax. In that environment, they incorporated a component called the bright line test. And the bright line test effectively said that if you had a person, place, or thing operating within the confines of that state, then by definition, you have what they would call physical nexus. Now, there's a lot of debate between legal parties in the courtroom as to who the retailer is of inventory. And I won't go into that area because I think I'll leave the lawyers to handle that and figure that part out. But we're on the compliance regulatory side of it, also making sure when these issues are present, protecting the businesses that are associated. So to simplify, if you're using Amazon FBA, they're going to send your inventory to every state they can, because they care about their logistics fees and they want to get as close to the clients as possible. That's their end goal. They don't care about your sales tax implications. They don't care about any of those other things, unfortunately. The thing here is that there's a lot of debate over who is the actual retailer and who's selling the product, since many of you can't contact the end client and other things. And so there's a lot of legal debate right now going on in that area. But as far as the law is confirmed today, if you're using Amazon, they're going to give you Nexus pretty much in every state, because they're going to shove your inventory everywhere, and they're not going to ask you for permission to do that. Now, part of the expansion now that has broadened, because the Supreme Court then re-reviewed Quill Wayfair in 2017, they incorporated a part with the economic nexus. And so what happens here is that they've now, above and beyond physical nexus that Amazon could establish, let's just say you're selling through a platform such as Shopify, and that's your only solution, you own your own brand. Once you hit certain volumes of sales in the United States, you still have to register with the states and collect and remit sales tax. If you're a foreign entity, you're really going to love our June services coming up very soon now, because there's a lot of work that you're going to have to go through and registering and getting bank account information, all that fun stuff set up. But the long and the short of it all is that on average, we're seeing in certain states that it's usually around $100,000 or 200 transactions on average. Now, some states like Texas, it's $500,000. Other states like Kansas, they don't even put anything there. They just kind of hit you right out of the gate. The economic nexus and all these things are items that you don't want to neglect or ignore, because of the fact that in the United States, the way it operates is that either you collect the sales tax or you don't, but the liability still remains with the business. So someone's paying for it, either your clients do or you, and you don't want it to be you. To kind of close things out a little bit and kind of move forward a little bit, the final piece I'll cover is Marketplace Facilitator. And specifically within Marketplace Facilitator, this is an area that's adding much more complexity, in the sense a lot of retailers say, well, awesome, Amazon's collector remitting on my behalf, I'm good to go, don't need to worry about it, awesome. And nothing could be further from the truth. First and foremost, Amazon sits in those meetings with the Marketplace Facilitator laws, to be honest with you. Everybody knows it's the elephant in the room that they get what they call collector's discounts, which means that for that sales tax that they're collecting on behalf of your business, they're actually getting compensated for doing that. So it's not like they're doing anything because they're nice guys. There's a whole revenue stream from all this. So Marketplace Facilitator, what it means is that when you sell within certain platforms, Amazon, Etsy, or eBay, as an example, they may collect and remit on your behalf. Now, a lot of sellers will get confused by this and saying, well, I'm good to go. It's they're already doing it. The long and the short is that they never delineate, or they never confirm who they're collecting and remitting on behalf of. So the states have no clue if your business is actually in compliance or not. So when you don't register and you're leaning on the Marketplace Facilitator to do these components, you still could potentially be subject to audit. Your liability might be limited at best, but you're still exposed as far as a state wanting to take a peek under the covers and make sure that you're fully compliant, and there's no loose ends. So that's an area to understand. Accumulated liability, when it comes to these states, to be very candid, there's this component called successor liability. And a lot of people get confused in this. And here's the big thing here. If you ever wish to sell your business, tax debt follows that business regardless of ownership. So for investors that, or some point you have a game strategy to actually eventually sell your business. If you have liability, when the new entity acquires, that liability will follow the new entity. And so, for example, we get hired in cases by JP Morgan, Goldman Sachs to actually evaluate businesses for tax exposure before they get acquired. Because nothing worse than having to drop a couple $1 million on a solution only to find out that you're going to owe 200,000 in the state of California. That's a bit of a nightmare. So, in conclusion, the final piece I'll say here, because my time's wrapping up, is don't panic. There are solutions in place. For example, what Ampersand does, along with Aqueduct, is a culmination of both the services and the technology. We have a tool that's very similar to some of the solutions you may have heard of before, not to name competitors, but like a TaxJar or Avalara. That's pretty much what we do, and strictly in the US market only. Plus, we have a services team that can assist with registration, audit defense, any of those other components. If I give any advice to anybody, it's attack this early on when you're entering the US market. You can make a lot of money in the US market, but if you're not careful, you can lose a lot of money in the US market as well. So it's critical to understand the rules associated with it in this market. In conclusion, thank you all for your time. I appreciate everyone that has listened to us. Any questions we'll be answering shortly. And then also, if you need to reach out to us, and you'd like to hear more about our services or our software, you can reach out to us at sales@ampersandaccounting.com. And we'd love to answer more of your questions there.